Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options, a low-risk alternative to hedging currency moves in any market condition.
So with this example, under the current implied volatility conditions that we're viewing here, the market maker is essentially looking at the value of the underlying security, looking at the current market conditions, and essentially pricing options such that that he or she believes the stock or the pair value or whatever it is that is under observation is going to remain within a certain price range. And the idea is that that because there is a relatively high probability that the security is going to remain in this range between now and expiration, the options will be priced accordingly to ensure that when the market maker has to assume the other side of the trade and take on the risk of assuming the other side of the trade, they're essentially getting paid to take on that risk. And it's really reflected in what we would be looking at as an options trader as the time value of the option contract. So everybody who has looked at an option premium will recognize that the time value component of an option contract is highest when it's at the money. So you'll notice that when we're looking at this distribution, what we call a distribution bell curve here, is that if we think of the option premiums as being this sort of along the lines of this bell curve, as we get closer to the actual price of the underlying security, you'll notice that the option premiums will increase such that the time value component will be highest directly at the money. Now, in this scenario here, as I said, the market maker is looking at the underlying security remaining between $45 and $55 within a certain time frame, and they've essentially established a 68.2 or close to a 70% probability that that's going to take place. If we look at how the curve behaves as we move outside of this single standard deviation here, you'll notice that as we move out to these lower strike prices, the percentages become lower, and consequently an option contract that is sitting at a strike price that is outside of that one standard deviation, or let's say in this example around the value of 40 here, may be priced at, say, 10 cents. And as the strike prices obviously get closer to at the money, then the value of those option premiums will increase. Consequently, if we slide to the other side of the bell curve here, the option contract that might be considered in the money, in the case of a call option trading, with a 60 strike price here, may also be trading at 10 cents. The idea is that as we get outside of these ranges on either side of the underlying security's price, the probabilities of that security being within that range on expiration decrease, and consequently there's less risk for the market maker to assume the other side of the trade. And this really essentially illustrates, as I mentioned, how the time component of an option premium is adjusted with out-of-the-money options and deep-in-the-money options having obviously the lowest time value, and as the option strike prices are closer to at the money, this is where that time value component increases. So if we look at the adjustment to volatility, when certain market conditions change, implied volatility will expand, and this is based on the risk that the market maker has to assume to take the other side of the trade. So in other words, if we want to buy the option contract or if we want to sell the option contract, if the underlying security is now believed to have a high probability of making a more significant move, it becomes more of a risk for the market maker to take that opposite side of the trade. And consequently, when these conditions change, we see implied volatility expand to reflect this risk. And what happens here is, and incidentally, that measurement of rate of change is known as the vega. So when you're looking at your options chains, recognize that the rate of or the measure of implied volatility on an option contract is the vega. But if we look at the implied volatility distribution curve here, and we look at it as expanding. Essentially, what we're looking at is market conditions changing, and the market maker now feeling that that there is a greater risk in assuming the opposite side of the trade, and once again, this risk may be due to a number of reasons. It could be a pending economic announcement. It could be an interest rate adjustment. There are any number of reasons why it might be perceived that there is going to be a big move in the underlying security. But as a result, the market maker needs to make an adjustment so that they can essentially offset some of their risk in assuming the opposite side of the trade. So if we now look at this expanding implied volatility distribution curve here, the previous example that we were looking at, we saw that the market maker was really pricing a 68.2 or 70% chance that the underlying security was going to remain between 45 and 55. But once again, as that volatility expanded, so I'll just illustrate that again, as the market maker adjusted for that implied volatility, the price range or anticipated movement of that underlying security now is increased, and the market maker assumes that within the time frame of the option, that there is a high percentage probability that it is going to be between, in this case, 42 and 58. Now, what happens is if we look at this curve widening out, we in fact basically should stretch this top part out as well, because as that implied volatility increases, the at-the-money options here, in the case of the underlying being at 50 and a 50 strike, will also increase in value. So again, not only will the distribution curve expand outwards, but it will also move upwards as well, and all of the options will be adjusted accordingly. So you'll notice where the 40 strike that we were looking at originally was essentially at or slightly outside that standard deviation here of 2, you can see that now it's a little closer within that range, and consequently the option contracts will be adjusted accordingly. And this will happen with the 40 strikes, and it will also happen with the 60 strikes. So where those contracts may at one point have been trading at 20 cents under the previous implied volatility, as implied volatility expands, those option contracts will be adjusted to reflect the probability of the underlying moving into that range, and the price will again increase. So it's important to understand that obviously when we look at it from this perspective, that even though the underlying security may not have already made that adjustment, the fact is that these option contracts are being adjusted on a day-to-day basis, or in fact throughout the day, to reflect this anticipated change in the underlying security, and consequently your option contract premiums will be changing and adjusting, even though the underlying security may not be. But again, what we need to do is just recognize when, in fact, the options are trading with a high implied volatility, or when options are trading with a relatively low implied volatility. Now, when volatility contracts, this essentially means that the market is not moving or has not been moving as it has been in the past. So consequently, where the historic volatility of the underlying security may have been quite volatile, as that security begins to slow down or decrease in price swings, what happens is the implied volatility will decrease as well.
Thank you for participating in this week's session. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.